The home buying hangover is kicking in. The real estate bubble is poised to burst. Greetings, Real Talker, and thank you for coming today. Today's show will show you where to look for 7 different signals a real estate bubble in the United States is set to explode. Let's start with the headline from Redfin, who states that as early indicators of house buying activity falter more against increasing interest rates, more sellers are dropping asking prices. And early-stage home buying demand continues to fall in the spring, as new listings fell 7% from a year earlier according to Redfin. And here are some early indicators that also show demand is softening at a time of the year when it typically springs up. In fact, the first 2 weeks of April are usually the best times to buy and sell homes. Most transactions are completed, and many deals are completed. But check this. According to a Google search for homes for sale for the week ending April 9, fewer people are genuinely looking to buy, down 3% from a year earlier. And the ceiling-adjusted Redfin Home Buyer Demand Index, which is a gauge of demand for home tours and other home buying services. When people are interested in buying a home, they look at it and tour it. This has decreased by 3% in the last 4 weeks, compared to a 5% increase the previous year. In addition to exhibiting firm showing time, it also shows tour and activity from January 1st to April 10th, with a 23% percentage point drop from the same period in 2021. Fewer individuals are out looking at houses, according to Sane. Let's take a closer look because Redfin is also keeping an eye on the rising number of homeless teenagers with price decreases, which has been climbing at a breakneck speed since at least 2015 and is another evidence that demand isn't me. Sellers, for example. It's simple, or whatever you're selling may be a car if you've ever sold a home and had to drop your pricing. There's a shortage of demand when you have to cut your price. Then, all of a sudden, you start to notice cheaper prices, which continue to fall as sellers flee. Let's take a look at what's going on with mortgage rates for the new purchases out there. Another reason we could see this bubble burst is that, according to the Wall Street Journal, mortgage rates are at 5% for the first time since 2011, and the monthly cost of buying a typical home has increased by more than a third in the last year, according to one estimate. Buys the media, buys the median American homeowner prevailing rate, but a monthly mortgage expense of roughly $1,223 after a 20% down payment. At current rates, such a purchase would cost Recaro $1,700 per month, a 38% increase from where it was before. And as far as wages go, we've talked a lot about how they don't keep up with inflation. This means that more money goes to the mortgage payment and less goes elsewhere. Buyers will be turned off by higher pricing since they are trying to absorb higher consumer prices and can't afford the higher mortgage payments. Despite the fact that pricing may come down, and even JP Morgan CEO Jamie Dimon has gone nuts, enormous forces threaten the US economy. Other sections of JP Morgan's consumer operation witnessed total revenue dip due to lowering profit, rising rates, and supply chain snarls. Mortgage originations fell 30% year over year in the third quarter, owing to rise interest rates on home loans and vehicle loan origination of struck 25. Suddenly, due to a paucity of vehicles, a 37% drop is significant. In addition, Wells Fargo offered more mortgages than any other bank in the United States in 2021. In addition, their mortgage originations are down 27% from a year ago. And you might be wondering why any of this matters. What difference do these transactions create in the situation? I'm straightforward. If you've ever called a realtor to advertise your house and ask, "What is my homework?" the first thing they'll do is look at recent comparables in your region for homes that have sold in the same size range as yours with similar features. And if there aren't any transactions going on and they're starting to shrink, it suggests they have no idea where the pricing is. That in turn means that as the number of transactions decreases, so does the amount of interest, and this is a major issue. So when you see a drop in mortgage originations all of a sudden, it signals people, hey, I think the peak is in, and I'm going to back off, especially if you're looking to refinance at a higher rate. Of course, your payment will increase, and right now, a lot of individuals are eager for greater payments, especially with inflation out of control. However, the Dallas Fed, in a recent study in Time Market Watch, found evidence of a growing housing bubble in the United States. Another US housing bubble is forming, based on our evidence of aberrant housing market activity in the US. For the first time since the early 2000s boom, there are strong causes for alarm a certain economy. Housing prices appear to be increasingly out of pace with fundamentals in 2021, as evidenced by the price-to-rent ratio and the price-to-income ratio. And, once again, this is a narrative of inflation spiraling out of control, with people unable to afford increasing prices. When there aren't many buyers and you need to sell, price has to come through. During a housing crisis, there is one thing that should not come down. Sure, first check out the portfolio. I'll include a link in the corner and an explanation underneath. You'll be glad you did because the labor market plays a significant role in this situation. Let's examine what happened this week because the job market has changed, which means the chances of being laid off are at an all-time low. As a result, this is good news for buyers who may demand higher salaries as a result of the jobless claims. Since 1968, employment security has improved. And we can observe that initial claims went from a low of 160 south of 67,000 rows to 185,000 rows. And as we've already noted, anything in the low 200,000s is incredible. So it's amazing that we're under 200,000. What happens, however, when things are at a low point and begin to rise? What does this have to do with property prices? We'll look into it. I've got a chart here from the St. Louis Federal Reserve database that shows the 4-week moving average of the first claims versus the S&P Case-Scholar U.S. National Home Price Index. While there was little of a slowdown during the dot-com bubble, prices are still rising. That's where unemployment claims began to fall and climb leading up to the great financial crisis when property values peaked and prices began to fall, and you start to think about it. People who lose their jobs cannot afford to keep their homes. After that, they become compelled sellers, which results in lower prices. But what if we go a little deeper than that? The factor is actually a yield curve. One of these issues is that the bubble is gonna burst. Let's take a look because we've got the 10-year Treasury yield minus the 2-year Treasury yield in blue and the Schiller U.S. National Home Price Index against the same scenario. But this time, on a year-over-year basis, the zero barrier for home prices is right here. It's right in the center of your chest. So now, we can see that as the yield curve steepened in 1990, home values actually went down, but not significantly. Look at 2000. Stephen, we see the curve and hope suggests growth. Simply slowed because it had to get down there. It didn't go negative. However, as the great financial crisis progresses, the curve steepens and home price increases become sluggish, slow, and ultimately negative. We've come full circle. We've arrived. Before arriving, we see that the curve has become steeper. Home price rise dropped after the PA pandemic began to spread. Although it did not reach negative, the curve is already approaching steep. Start steeping it again, implying that housing prices may really go negative once more, like they happened during the financial crisis. So there are warning indicators. It's possible that a bubble will burst. Of course, we know from history that the Fed always deflates asset bubbles. More rate hikes and a balance sheet reduction are expected as the Fed tightens monetary policy, reportedly starting this summer, while the housing market could experience a repetition of what happened in 2008 and 2009. Home price and income growth are intertwined according to fundamental economics. Neither can outpace the other for long periods of time. That is what is alarming about the pandemic's housing boom. Home price rise 20.6% has been 4 times larger than the income growth in the past year, which is 4.8%. As a result of this disparity, more economists are toying with the two most despised words in real estate, housing bubble. According to Mark Zandi, chief economist at Moody's Analytics, using such word is premature. In his opinion, a bubble would require both speculative price increase and overvaluation. Nonetheless, we do encounter at least one aspect of a bubble, overvaluation. According to Zandi, property prices in the United States are now priced ahead of what underlying economic statistics, i.e. incomes, would justify. However, by historical comparison, overvaluation differs widely by market. With displaced remote workers publishing home values in markets like Austin, Boise, and Charlotte rising much over the national rate of growth, the housing epidemic boom, which is now coming to an end, was hardly even. To find out where things stand on a local level, We contacted CoreLogic to ask if it would redo the proprietary housing analysis it offered us in April using the most recent data. Rising mortgage rates are putting the thriving housing market to the test. The 30-year fixed mortgage rate averaged 4.67% last week, up from 3.11% in December. That's a bigger concern than it appears at first. Over the course of a 30-year loan, a borrower who took out a $400,000 mortgage at 3.11% would pay $1,710 every month. That monthly payment jumps to $2,067 with a 4.67% mortgage rate. Higher mortgage rates not only price out some would-be home buyers, but they also mean that certain borrowers would lose their mortgage eligibility due to lenders' tight debt-to-income ratios. Some in the real estate business believe that the hot housing market will ultimately cool off as a result of the economic shock provided by mortgage rates. CoreLogic is the place to go. Home price growth is about to slow dramatically, according to the real estate research firm, which is placed 952 in the Fortune 1000. Between January 2021 and January 2022, housing prices in the United States increased 19.2%. However, CoreLogic predicts that property values will only climb 5% in the next year. Another reason for the slowing of home price increase, according to CoreLogic, is affordability. Home prices in the United States have risen 5 times faster than income growth in the last year. That can go on for much longer. Entering into 2020, the nation already didn't have enough homes built to satisfy millennials who were entering into their peak first-time home buying years. Then the COVID-19 crisis struck. The ensuing record-low mortgage rates and flexible work-from-home policies, which allowed buyers to expand their home search further into the burbs, only attracted more buyers into an already tight and competitive market. Simply put, the pandemic created a perfect storm in the housing market. However, the unprecedented price surge may be coming to an end shortly. At least, that's what the latest CoreLogic projection says. The S&P CoreLogic Case-Shiller Index shows that home prices in the United States rose 18.8% between December 2020 and December 2021. More than 4 times the nation's average yearly rate, 4.2%, since 1989. CoreLogic predicts that home price growth will be closer to the historical average in the future. CoreLogic predicts a 3.5% increase in home prices between December 2021 and December 2022. We're already seeing a slowdown in property values. Home prices in the United States increased by a record 20% between August 2020 and August 2021. However, over the next 4 months, the 12-month growth rate slowed to 18.8% in December. Much of what we've witnessed in the recent years' run-up in the property prices has been the result of a perfect storm of supply and demand pressures. As we get closer to 2022, economic drivers including new home construction and rising mortgage rates are in motion to relieve some of this pressure and gradually soften the fast home price acceleration observed in 2021, says Frank Nothaft, CoreLogic's chief economist. Mortgage rates have begun to rise in recent weeks as financial markets price in future rate hikes by the inflation-conscious Federal Reserve. According to Freddie Mac, the average 30-year fixed mortgage rate hit 3.92% last week. This compares to 3.11% in December. Rising mortgage rates, of course, put downward pressure on price growth as each increase in mortgage rates prices some would-be purchasers out. However, just because rising mortgage rates slow home price increases does not imply it will help home buyers. After all, pandemic-induced low mortgage rates have helped to mitigate the impact of rising property prices over the past 2 years. Mortgage payments for new borrowers will rise when interest rates rise. However, not everyone in the real estate industry agrees with CoreLogic's estimate of a slowdown. Zillow is the place to go. The house listing site recently raised its home price projection again. According to Zillow, the year-over-year pace of home price growth will peak at 21.6% in May and end at 17.3% in 2022. That is an acceleration, not a deceleration. What makes Zillow so optimistic? It claims that there aren't enough houses for sale. Inventory levels in the United States are down 42% from pre-pandemic levels as the spring housing market begins. Even with rising mortgage rates, the supply, aka inventory, and demand, aka home shoppers, mismatch is expected to push prices higher. For about 400 metropolitan statistical areas, the real estate firm generated a market risk assessment. CoreLogic wanted to see if local income levels could keep property values high. According to CoreLogic, 65% of regional housing markets in the United States are overvalued, including major metropolitan statistical areas such as New York, Miami, Seattle, Las Vegas, and Dallas. Every major market in Arizona, Florida, Texas, and Nevada satisfy CoreLogic's definition of overvalued, while only 26% of US housing markets are average and only 9% are undervalued according to CoreLogic. With robust home price growth since the onset of the pandemic, many markets could now be considered overvalued, particularly when comparing the price growth to the rate of local income growth, Selma Hepp, Deputy Chief Economist at CoreLogic said. However, just because housing prices in the United States are overvalued does not indicate they are ready to fall. Indeed, every forecast model examined by Fortune forecast that property prices in the United States would climb in the following year. The Mortgage Bankers Association, Bank of America, Fannie Mae, and Zillow all produce models in this category. What's the matter? Soaring mortgage rates, according to industry insiders, will assist to derail the unsustainable rates of housing price growth since over the past year. Many predict, however, that the combination of limited supply and the generational tsunami of first-time millennial homebuyers will continue to drive prices higher, albeit at a slower rate. For about 400 metropolitan statistical areas, the real estate firm generated a market risk assessment. CoreLogic wanted to see if local income levels could keep property values high. What was discovered? CoreLogic now considers 67.9% of regional housing markets in the United States to be overvalued, up from 64.7% in April. Meanwhile, CoreLogic now considers only 24.5% of housing markets in the United States to be normal and only 7.6% to be undervalued. Because sales figures take several weeks to become final, the April analysis used final house sales information from February, while the latest analysis utilizes final data from March. Is a cooling housing market, however, implying that home values will soon fall? CoreLogic predicts that property prices in the United States will grow 5.9% in the next year. However, the real estate agency estimates that some regional home markets are more likely to see a downturn. CoreLogic looked at things including income growth projections, unemployment forecast, consumer confidence, debt-to-income ratios, affordability, mortgage rates, and inventory levels to see if regional home prices would fall. CoreLogic then classified regional housing markets into one of 5 categories. Very high, over 70% chance of a price dip. High, 50 to 70% chance. Medium, 40% to 50% chance. Low, 20 to 40% chance. Very low, 0 to 20% chance. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!